The Competition Bureau in Canada says that the stress test is not fair to all borrowers. OFSI says take a hike. Yeah, all this and more with our good friend and mortgage broker, Mr. Dion Beg, right after this. Here we are, my friends, with our favorite mortgage broker in all of the land, Mr. Dion Beg. How you doing, my man?
Hey, Gary, fantastic, man.
Excellent, excellent. I can't believe we were almost at the end of March, and Dion and I were just looking at some stats dating all the way back to 1988, and we're going to bring them up for you here shortly. But man, what a crazy couple of months this year has already been, Dion. What's going on?
Yeah, no, I think we've seen some activity. Some of these clients that have been sitting on the fence are finally coming back into the market. A couple more have purchased. And it's that whole idea, Gary, that, as much as there's been some ups and downs in relation to what we're hearing about rates on a day-to-day basis, the feeling is that we're going down. And so a lot of these people are sort of buying into this idea of, marry the price, date the rate, where they're buying now. They're taking variable or shorter term mortgages, and they're actually hoping that as the economy changes, that we will be able to get them better rates in the near future.
Excellent, excellent. And one of the interesting things you just brought to my attention is the Competition Bureau is poking around and looking at mortgage rates and how mortgages are set, and more importantly, the renewals and things like that. So explain to us, why is the Competition Bureau, I can't even say it, Competition Bureau poking around and asking really good questions?
Yeah, so it goes back to something you and I spoke about several months ago, which is the fact that when your mortgage is up for renewal, if when you purchased your property or when you got your mortgage, you got an insured mortgage and you want to change lenders, you only have to qualify at the new lender based on what they call the contract rate, which is the rate that you're actually getting, right? Versus the qualifying rate, which is more commonly known as the stress test, which is usually 2 percentage points higher. Of course, if you had to qualify at that qualifying rate, it would actually probably, for many people, make it a lot harder to change lenders, right? And therefore, you're kind of feeling stuck with the first lender, and that first lender doesn't have to work as hard to keep your business and offer you the best rates possible, right? So the Competition Bureau got wind of this and said, you know what, this is probably not a good thing. This is probably something that we should, for the sake of Canadians and the competition in the market, abolish this requirement of qualifying at the qualifying rate stress test, so that it would be easier for Canadians who don't have an insured mortgage to shop their mortgage at time of renewal. And just to qualify what an insured mortgage is, or an uninsured mortgage, it's if you have 20% down or more, or you put down 20% or more when you purchased, or when you refinanced, you did so at more than 20% equity in your position, right? So the thing is, that makes sense to you, right, Gary? Like, it makes sense to abolish that type of stress test so it makes it easier for competition. And you would hope that when they made the appeal to OSFI, the Office of the Superintendent of Financial Institutions, that they would have seen the light as well. But OSFI has actually decided no, they're not going to allow that. They're going to keep things as they are, effectively continue to make it difficult for people to shop their mortgage when it comes time for renewal.
Yeah, it seems so backwards to me. And explain to us why banks love the insured mortgage aspect as well. Because obviously they like to balance their books, and who doesn't? But there's a little added value, or a lot added value, from that insured part, right?
Okay, you know what? Let's use a simple example. Let's say, Gary, that you're the bank and you're going to lend money to me, right? And I come to you and I say, okay, Gary, I've got a house worth $1 million. Will you lend me $500,000? And you'd look at that and go, you know what? That's pretty good security, right? So you'll lend that, right? You'll lend that money to me. Now, if I came to you and I said, hey, I've got this house, it's $1 million. In fact, let's make it just under $1 million, 999,000. The reason being, you can't insure a $1 million mortgage. But let's say it's $999,000. Could you loan me $900,000? Okay, you would probably stop and say, you know what? I'm not so excited about lending you 900 grand. It's, effectively 90% of the value of that property. And you might not lend to me. But if behind you there was an insurance company that said, "Hey Gary, if you lend money to Dion and Dion defaults on his mortgage, Gary, don't worry, we'll cover the difference, okay? And we'll ensure that you won't lose any money, okay?" Would you move forward with that loan at that point?
Well, yes, because likely I'm adding a little extra couple of basis points to get more money, right? From you as the borrower.
The insurance company is, and yes, and also you could potentially do that, but in fact, it's
But
interesting. Insured mortgages are generally cheaper than uninsured
okay.
mortgages,
Yeah,
right?
fair enough. That's a good
Um,
point. Yeah.
yep. But in
But
the
yeah, I,
background, what? Yeah, go
I'm
ahead.
insured. It's a win-win for me, is it not?
Correct. So the interesting thing is that those what the regular person on the street would see as the riskier mortgage is the type of mortgage that the bank wants because they don't take the risk. The risk
Mm,
is taken by the insurance company. One of the largest insurance companies, by the way, is CMHC, funded by the Canadian government, funded by your tax-paying dollars. Okay, so of course, if I'm a private institution and I have an insurance company behind me that's backed by mostly public money, I want to lend that money all day, every day. And so that's why banks love insured mortgages.
right. Interesting.
Mhm.
Interesting. That's what we do here. We peel that onion away. Okay, talk to us. And I know the word on the street, and everyone's kind of been getting ready for this conversation over the next 18 months, 24 months, and it's starting right now, is mortgage renewals and how that's, what you just described,
Yeah.
how that perhaps is going to affect that.
Okay, so listen to these numbers, right? So by the end of next year, we have about 2.2 million mortgages up for renewal. Okay, so
Wow.
2.2 million households in Canada will be jumping in interest rates significantly in most cases. Now, over 70% of them, 73% of those are uninsured mortgages. That means those 73%, that's 1.6 million households, will have to be, if they want to move lenders, they're going to be exposed to the stress test. And many of them will not be able to move as a result of that, right? So they're going to be stuck with the lender that they're at, and all they can do is hope that their lender is going to treat them fairly,
Mm.
right?
Yeah, yeah,
So
that
that's where we're at.
kind of staggering. And what talk about some of the ripple effect that's going to come out of that. What do you think is going to happen? Are you going to have a lot of people that obviously just signed that renewal letter? Do you think we're going to start to see some more listings come up, or
Well,
other lending opportunities, perhaps?
so the interesting thing is that we've had about 40% of the mortgages that were going to renew already renew.
Right.
So we have certainly seen cracks in the system, right? We certainly have seen people struggling and some people forced to list. But I think you would agree when I say it's not as many as you would have probably expected, given the significant jumps of, over $1,500 a month on the average mortgage, right? Canadians somehow are still holding it together. What has happened though is a significant slowdown in spending in outside of the house. So what's happened is more Canadians have had to channel their income to debt pay down and debt repayment, and therefore are not spending it in the economy. And that's where we're seeing this inflation number now down to 2.8%. In spite of the fact that 30% of that number is shelter costs, and that shelter cost has jumped dramatically, inflation is down, which tells us that those 40% of households who have already renewed have had to stop spending elsewhere. And if you can imagine these next 60% of households who have to renew by the end of next year, if they follow step and they also reduce spending, then our economy is going to slow very dramatically.
Yeah, yeah. And we are seeing, and from my side of things, from the sales and as what we track, obviously, in that medium and average price, we are definitely seeing an uptick month over month, and it'll be interesting to see March's numbers as they come out around March 6th or so. Sorry, April 6th, as that reports, but we're definitely seeing an uptick in the number of transactions along with that pricing. So we're definitely seeing people get off that fence, as you said earlier in the call here.
Yeah.
Okay, you sent me a pretty interesting article, or maybe a headline. Should we share that?
Well, interesting or scary. And I mean, yeah, we just spoke about this last week where as we just spoke here, we talked about the fact that it's getting harder to qualify. In fact, before we jump to that, Gary, can I just talk about one other sort of rule that's come out from OSFI
Yeah.
in relation to mortgage qualifying that's going to actually come into effect next year? And that is what they call your debt service ratio as it relates to your income. Okay.
Mm.
So anybody in the real estate industry knows this rule of thumb, and the rule of thumb used to be you could borrow about 5 times your income. Okay, that was the ballpark middle of the road number. So keeping it simple, if you came to us, you had $100,000 income, household income, and no other debt, then you'd probably be able to borrow around $500,000. Okay, now when rates dropped dramatically, we were actually able to get that number up to 6 times income.
Mm.
Okay. And now, as rates have increased significantly, we're now somewhere around 4 to 5 times income. But if you have good strength in qualifying, we can still get you closer to 5 times income. Okay, so that's the sort of the history of where we're at. Now, going forward, the truth is that as rates drop, more and more people should be able to qualify for 5 times income, maybe even a little bit more when rates drop. But again, OSFI's stepped in and said that they would like to now have each lender stipulate a certain amount of their book that they allow to borrow more than 4.5 times their income. So even though you qualify, you may not be in that allotted allowance for that lender as of next year. So what they're basically saying, and what's likely going to happen as a result of this, is that banks are going to really reserve that level of lending to people who have probably extremely high credit scores and more probably higher net worth. And in doing so, what's going to happen is that, and we hear this, the rich get richer. The people who are already in positions of power financially are likely going to be extended that opportunity to borrow more than the regular person, right? And the
Mm-hmm.
regular person is going to get capped at that, say, 4.5 times income. And they may not be able to then buy the homes they want or expand their portfolio in real estate investing to the way that they want because of these new OSFI rules. And that, combined with what we mentioned earlier, which is your inability to shop around at time of renewal for a better rate, those two things sort of amplify this ever widening gap between regular people and the people kind of at the top who have that ability to move around and or qualify for higher. So yeah, so this leads into the article that we sent you here, Gary. So why don't you go ahead and pull that up?
Here we go. Okay, walk us through this a little bit here. This is quite the shocking headline. It's definitely the clickbait.
Yeah, certainly the headline is clickbait, but it's in line with what you and I just discussed 7 days ago. You and I had a conversation talking about disparity in wealth leads to revolution, right? And again, I tempered that with the idea that we're probably not quite there in Canada, but it's certainly visible in other countries. But just in the days after we spoke, the RCMP came out with this report, which has now been widely published, which basically drills down on the idea that when you have people in their mid-30s who wake up to the realization that they will never be able to buy a property in the same way that their parents did, and they'll never be able to maybe have the same type of lifestyle that their parents did, that it could in fact, they could in fact revolt once they realize how broke they are. So, I mean, again, it is a headline, but the truth is, if you look through the headline and look at the RCMP report, they have noted that unaffordable housing is a real contributing factor to discontentment in the Canadian citizenship. So, the problem that you and I sort of speak about at a high level could very well hit the streets. They've chose to put this image, one of these inflammatory images
Yeah.
here, right? But you know what? This wasn't that long ago in Ottawa for a different reason. But could it be the case that people who are your regular Canadian who expected to be able to live the life their parents live and realize they now can't, are they going to be upset? And what's the aftermath of that? I don't know.
Yeah. Yeah. Well, I didn't notice this earlier, but I did as I just brought it up here. There's almost 2,000 comments
Oh,
on
right.
this article, and what this is only from on March 20th. And
4
granted, a
days.
lot of it's probably just internet trolls, but there's going to be some truth as you filter through some of that. Don't go read all 2,000 comments unless you want to entertain yourself. But it's kind of where we're at right now, right? Is there's definitely a shift happening with home ownership, and in order to obtain home ownership. I think, Dion, we've been talking about this for, several, in fact, a number of years. I was going to say several months, but I know you and I have been talking about this
Yes.
for a number of years.
Yeah.
We need to shift our mindset on how home ownership is obtained and who we perhaps partner with, like family, to make that home ownership, or your first time, for your first time buyers, and the like. Or even
Exactly.
on the other end of it, perhaps you have parents that are downsizing, and we've seen and heard stories where people will downsize, or perhaps property size where there's multiple dwellings, where perhaps parents or aging parents can now live with their children, their the 40-year-old children type thing, right?
Yeah, I mean, I think those types of households are going to become more and more common
Yeah,
over the coming years.
yeah,
And yeah, I don't think, honestly, I don't necessarily think it's a bad thing. I think that we've moved into this very individualistic society where we sort of spend a lot of time by ourselves. I think returning to somewhat more of a family and community type environment is a healthy thing.
yeah.
That's just my personal opinion. Yeah.
Yeah, yeah, I think that's well said. Okay, as we wrap up here, I want to show our viewers kind of, and we're going to have this conversation about where we came from to where we're going, and maybe some things we can watch out for with average sales right across the GTA. And it really is in line with everything you've been saying here, Dion. Let me just bring this up here like this, and I'll go like this. And this is dating back all the way to 1988. I know these numbers are small, but trust me, that does say 1988 there. And we can move forward all the way into February of 2004. And what we're looking here at, my friends, is detached homes right across the GTA. And for those that want to know, we ended February with an average price of 1.443. Okay,
1.4.
one million
Yep.
443,000. Why is that significant? Well, you can see that in January we started at 1.349, so that's $100,000 increase month
Right.
over month. And it's been your experience, my personal experience, that March is also creating perhaps the same type of numbers. And we've moved into definitely that entry level home, as we've been sharing, wherever you may happen to be in the GTA, that is of multiple offer scenarios. So interesting numbers as we're looking at this. Of course, we had the peak, but if we take out that peak, we still have a pretty significant climb there. And these are things of, this is why you need to have your ear to the ground, to talk to people like Dion, talk to people that like myself that can help tell the story of what's happening on the street as well. Right, Dion?
Yeah, I mean that $100,000 jump as it relates to mortgages, Gary, is probably about an extra $600 a month in mortgage payment. And so, yeah, I think the longer we wait, the longer people wait, unfortunately, the higher that number is going to climb. And then, of course, when interest rates drop, that's when everybody's going to run into the market. And my guess is that if we look at this a year from now, that line will be significantly higher than where it is now.
Yeah, yeah. And I like that you equated that to that $100,000 is approximately another $600 payment, or in addition to, right? How does that affect, to your earlier comments? How does that affect to, if my salary is 100, or the average is 140 grand household income? How does that affect perhaps that buying power of what we have?
Yeah, so I mean, just keep in mind. So I'll put it in a different context.
Sure.
Let's say you had a car payment. Sorry, let me do the math real quick. Now I'm going to bore you with the math, but let's just call it around 750 grand is what you would be able to buy, right? So
Yeah.
let's just say right now, today, you have a property out there that's $750,000. Okay, and your household income is 140, 150 grand. You're probably somewhere in striking distance as long as you've got close to the 20% down payment. Now, if we were to wait until interest rates drop, number one, your qualifying rate will improve. Sorry, your qualifying will improve as the rates drop. But the flip side is that $750,000 house won't be worth $750,000 anymore, right? Because of the competition that comes into the market at that time. And so a lot of the clients who we've seen buy now understand that, and they're like, we would rather buy now with less competition, than buy in the future when we don't know if our 750 will get us what we want, right? So they're basically taking, I would call it a safer option, less of a gamble. Whereas those sitting on the sidelines are taking more of a gamble, understanding that they're going to go offer in competition. And you know what? That property might, let's just say, for argument's sake, it goes up to $800,000 in value. The question is, will they still qualify? Even though the rates have dropped, will they still qualify? And the thing is, I think the prices will jump at an amplified level compared to what the interest rates will jump by. It only takes a very small drop in interest rates to see and you've seen this many times, a rush back into the market. So it's almost like if you, I don't want to sound like that guy's like buy now, but understand that by waiting, you may not be able to buy at the same dollar value or the same type of property for the same dollar value you will today in
Yeah.
6 months, 12 months from now.
Well, and to borrow your line, this is one of those great scenarios where you marry the price and date the rate in a sense, right?
Correct. Yeah. So you lock in the known, and then the
Yeah.
unknown is the interest rate. But the reality is that interest rates likely not going up. It's
Yeah,
going down.
yeah, yeah.
Yeah.
Absolutely, absolutely. And this is all important information to those like we said that perhaps feel like sitting back, waiting for the market to develop. We've seen it before. I can remember in 2018 when if I go back to that chart here for just a moment. This is 2017, that peak, and people were waiting as I move forward into 2018, 2019. They lost out on that opportunity down in here because they waited, and and that number started moving up. Here's the thing: what we're looking at is very general, and what Dion is talking about too. I don't want to say it's in simplistic, but when we talk about mortgages and mortgage rates, or the down payment that you have, we're often thinking, yeah, this buyer has 20% down, and that's your buying power. The reality is, many of us, perhaps that are watching, own a home with and I'm going to say a significant piece of equity, and that's also what we're moving. So your buying power is typically much more than what Dion is referring to, but in order to kind of call it apples to apples, that's why we talk in terms like this with 20% down and that type of thing. And we don't buy, Dion, we don't buy Greater Toronto real estate. We buy, Whitby or Brooklyn or, Aurora real estate and pockets. So when it does come time, make sure that you are, as a buyer and seller, you're getting that valuable local information. Because if I looked at average price here in Stouffville, where I live, compared to at Oshawa, as an example, the north end of Oshawa would be significantly different. So make sure you're getting that info and insight, my friends. This is why I love talking to Dion. This is why I always recommend you should be working with a mortgage broker when it comes time for renewal, as well as when it comes time, obviously, to purchase a home. Dion, remind us how to get a hold of you.
Yeah, kangamortgage.ca or Instagram at the Dion Beg.
The Dion Beg. All right, over there. I'm Gary McGowan. We'll see everybody on the next episode. Goodbye for now.